This is a topic, Income Tax Planning, 11th edition, Chapter 3. So we're going to discuss the income tax formula. This is just a basic idea of individuals' tax formulas. They take their income and they subtract deductions and they get to taxable income. You multiply that by a tax rate and then you get your tax liability. We're going to expand on this as we go through the chapter. Tax formula example. A single taxpayer has income of $30,000, deductions of $10,000, and taxable, so they have taxable income of $20,000, $30,000 minus the $10,000 in deductions. Using the 2018 tax rate schedule for the single filing status, the income tax liability is $2,209.50. So basically the first $9,525 is taxed at 10%, and then the additional $10,475 is taxed at the next rate because we have progressive tax brackets of 12%. So that's how we got to $2,209.50. Let's dive a little deeper into the federal income tax formula. So income is broadly defined, right? Less exclusions. So gross income, less deductions for AGI, which are called above the line deductions. Then you get to AGI. This is a magic number for a lot of credits and other things. You usually have to answer this question on personal tax forms or personal financial statements that you need. So at the gross income, you're going to subtract itemized or standard deduction, and the standard deduction has increased significantly for 2018. Less the personal dependency exemptions, so those are not available for 2018. Less QBI, which is only for 2018 or further, you get your taxable income, and then your tax on taxable income less any credits. So a credit is a dollar for dollar deduction in tax. So a credit is better if you think about it from a standpoint than a deduction, because a deduction, you just get that amount times your tax rate, so you don't get that full amount. So we'll talk further. So here's a partial list of exclusions of income. So when we talk about income, there are some things that aren't taxable. So interest on municipal bonds is not taxable. Child support payments from a former spouse is not taxable. So that's not included in income is what we're saying. Cash or property received by inheritance, it's not taxable for the person receiving it. Specific employee fringe benefits, which we'll discuss later. Qualifying distributions from a Roth IRA during retirement, not taxable. Interest income from municipal bonds is not taxable. Alimony post-2018 divorce. So in 2019, if your divorce happened then alimony is not taxable to the person receiving it and not tax deductible to the person paying it. But all divorces prior to 2018 are taxable to the person receiving it and tax deductible to the person paying it. Cash or property received by a gift is not taxable. Deferral contributions from certain retirement plans are not taxable. A gain on the sale of your principal residence, subject to the limitations. A scholarship or fellowship. Life insurance proceeds received because of a death. Or cash or property received by a gift. Some of those repeat. So we'll talk further about these exclusions in chapters 4 and 5. So gross income. By definition, it's all income from whatever source derived, money, property, or barter, unless specifically excluded by the IRS code, right? The IRC the Internal Revenue Code contains a specific provision for excluding particular items. Lots of people I hear talk about this like, oh, well, I heard if I win at the casino under $600, it's not taxable. That is not the case. It is taxable. You just didn't get a form to tell you to report it, but you should still report it. The IRS says report all income from whatever source derived. If you think about that, a lot of criminals, people that go down, you hear that they didn't go down for some of their other crimes, but they do go down for tax evasion. It's easy to find all the money that you are hiding, right, from your illegal operations. Income specifically under the Section 61. So this is compensation for services, including fringe benefits. This is taxable income. Income derived from a business, gains derived from dealings in properties, interest and dividends, rent and royalties, Alimony and separate maintenance payments required by a divorce entered in before December 31st, 2018. Annuity payments, income from life insurance and endowment contracts, that's not from death though. Pensions, discharge of indebtedness, distributive share of partnership gross income, income in respect of a descendant, and income from an interest in an estate or trust. So the distributive share of partnership gross income, this is also an area that becomes questionable. People always hear different things. So if you are part of a partnership and they have gross income, it will be reported, or net income really, it will be reported on a K1. Whether you got cash from that business or not, you still have to report the income on your personal tax return and pay taxes on it. So things that you can deduct. So these are above the line deductions for AGI. So alimony paid. So if you're paying the alimony for a divorce that happened before 2018, December 31st. Contributions to a traditional IRA. So I make money and then I contribute $5,500 to a traditional IRA. Assuming I meet the criteria for that, I can deduct the $5,500. Tuition for higher education. We'll talk further about tuition. You get a choice of an above-the-line deduction or a credit. Usually people take the above-the-line deduction when they don't qualify for the credit or phase out. Interest paid on student loans. A health savings account deduction is an above-the-line deduction. Business expenses, rent or royalty income expenses, losses from the sale of property, moving expenses. The moving expenses is suspended, so we won't talk too much about that, but from 2018 to 2025, suspended. Contribution to a simple SEP or qualified plan. So in financial planning, a lot of people will be self-employed or a small business owner, and they might contribute to a SEP, simple, or qualified plan. So you would see that. Adjusted gross income, it's called the line. It's used to determine limitations on deductions, credits, and phase out for tax benefits. Standard deduction or sum of. So you will choose the standard deduction or the sum of medical expenses above the threshold, interest, which includes your principal residence, and a couple other lists of interests. It's not credit card interest or interest on your car or any of that. Taxes, casualty losses, charitable deductions, and miscellaneous itemized deductions, which has now gone away. So here's a comparison of what happened from 2018 to from 17 to 18. The standard deduction went up. So married filing joint is $24,000 for 2018, and it was $12,700. Married filing separate is $12,000. It was $63.50. Surviving spouse, also known as qualified widow or widower, is $24,000. It was $12,700. Head of household is $18,000. It was $9,350. Single is $12,000. It was $63.50. And it's $1,000 for one claimed as a dependent. So say, for example, you have a child that's in college. You're claiming the child in college, but they also earned income. So they would get $1,050 or earned income plus $350 as their standard deduction. There's an additional standard deduction allowed for a taxpayer and a spouse, not a dependent, over the age of 65 and blind. So married filing joint, if one of you is over the age of 65 or blind, it's $1,300. If you're single, it's $1,600. And it was $1,250, so the other parts are here. So if you're single, if you're over the age of 65 and blind, you get both deductions. So if you're married filing joint and your spouse is over the age of 65 and blind, you would get $2,600 in additional standard deduction added to the $24,000 on the previous page. Some taxpayers must itemize. A married individual filing separate cannot use a standard deduction if the spouse itemizes. This is one of the very important details when people are filing taxes. So if we are married filing separate, we're not getting along, we're about to get a divorce, and I go ahead and I file first and I itemize, the second spouse is forced to itemize. So the person with the house may just quickly itemize. So if they do that, they are forced to itemize the other spouse, and they could have no itemized deductions. So I think with the increase in standard deduction to $12,000 each, it might be that people aren't itemizing anyway. Non-resident aliens are not permitted to use the standard deduction, and an individual who files a tax return for less than 12 months because of a change of annual accounting period is also not permitted to use the standard deduction. Charitable contributions. So this is a partial list of itemized deductions. So miscellaneous deductions subject to a 2% AGI is no longer pursuant to the Tax Cuts and Jobs Act of 2017. They are suspended until 2025. The things that are not suspended are amortizable premium on taxable bonds, casualty theft or loss, federal estate tax on income in respect to a descendant, gambling losses in the amount up to gambling winnings, impairment-related work expenses of a person with disability, losses due to a Ponzi-type investment scheme, and unrecovered investment in an annuity. So the things, so the miscellaneous is gone, but the things in right here are what is itemized. So charitable contributions, home mortgage interest, investment interest expense, state and local income taxes, subject to a $10,000 cap. All the taxes are subject to a $10,000 cap. So this has been in the news a lot because a lot of people are really upset, especially in high tax states like Massachusetts, New York, California, Connecticut, where property tax and income tax are high. This is limiting the amount of tax deductible. And then you have casualty losses in excess of 10% of AGI and medical and dental in excess of 10% of AGI. 10% is 2019 and forward. It was 7.5% for 2018. And basically that means if you spend $10,000 on medical expenses and your AGI was $30,000, then the first $3,000 is not deductible on there. And then you would go from there. So as of the Tax Cuts and Jobs Act, or TCJA 2017, they have suspended personal exemptions until December 2025. Partial list of tax credits. So we will talk about these in more in depth, but there is a tax for paying there's a foreign tax credit. There's a child and dependent care expense credit, which is a max of $600 per child with a max of $1,200, so for 2 or more. There's a credit for elderly and disabled. There's the education credit, which are the American Opportunity and the Lifetime Learning. There's a retirement savings contribution credit for low-income individuals contributing to a retirement plan. There are some residential energy credits, but the max is mostly $1,500. There's a child and family tax credit, which this has been expanded. There's an earned income credit, and there's an additional child tax credit, and then there are business and investment credits. So here's an example of the Anderson case, which is in your book. Paul has a gross salary, and then Paul makes payments to his 401k and retirement plan that's withheld from his salary. So this would not be taxable. So we would subtract that from his gross salary. Then he's married. He's got Stacy's salary, which is $22,000. She gets a gift from her mother. So remember, gifts aren't taxable. They do have interest income from a joint account taxable. This is their federal income tax withheld from their paychecks, so we're going to put that in the tax payment category. This is their state income tax withheld from their paychecks. This would go on a Schedule A if they're itemizing. Charitable contributions, which was $6,000, that would go on a Schedule A. They have rent, so they don't have mortgage interest, so that won't happen. And contributions to a traditional IRA, this is an above-the-line deduction. Here's how it's going to work. We add up their salaries together. We get their gross salaries. We subtract the exclusions, which were $7,400, and we get to a gross income of $56,100. Then we take the deduction for her traditional IRA contribution, and we get to an AGI, or the line, of $54,100. And we added up the standard deduction, itemized, but it didn't equate to more than $24,000. So therefore we take standard. There's no personal exemption. And so their taxable income is $30,100. Based on the tax rate schedule, which is posted in your course or in this book or online, the tax is $3,231. They had $2,500 withheld from their paycheck, and they contributed to a retirement plan and they meet that low income threshold, so that's $400 in a tax credit. And then they have a child, so each child has a $2,000 credit. So basically, we take this number, subtract this, this, and this, and they get a refund of $1,669. So let's talk about some basic rules of income taxation. We're going to talk about accounting periods, tax accounting methods, filing status, personal independency exemption, which was repealed, standard deduction for a dependent, kiddie tax, and other filing requirements. So normally a tax year is 12 months. Individuals generally use a calendar year. Some taxpayers, businesses, use a fiscal year. So there are methods. Cash receipts and cash disbursements is called the cash method. All individuals are reporting on the cash method. Then there's accrual. This is for business taxpayers. A lot of business taxpayers actually report on a cash basis, but some, depending on the type of business or if they have inventory, report on an accrual method. And there are some hybrid methods which are not specifically relevant here. So categories for individuals: married filing joint and surviving spouse. To be married filing joint, you must be married on the last day of the year. So if I got married in November, that would be we would want to file married filing joint, even though we weren't married the whole year. Married individuals filing separate, those are individuals who do not agree to file together. It's very rare that it's advantageous to file separately when you are speaking to each other and if you're just married and living with each other, it's very rare that that would be advantageous. Head of household means that you are not married and you have a dependent child, a dependent of the household. And single is unmarried, other than surviving spouses and head of households. And then there's estate and trusts. So married filing joint. If your spouse dies during the year, you would be considered married filing joint for that year. And then if you have a qualifying child that lives with you, you would be surviving spouse. This means you get lower tax brackets, higher standard deduction for the 2 years following the death, assuming that you have a child that lives with you. So why would we file separate? Often it increases your overall taxes. Usually it happens when the husband and wife are separated, or the married couple are separated, where one spouse suspects the other is not reporting income. So the other thing is, if I agree to file married filing joint, even though maybe I believe that my spouse is doing something incorrect, I could be held liable. So if I feel they're not reporting income correctly, I might want to file married filing separate anyway. Or to tax minimization purposes. Occasionally there are situations in which your tax is lower by married filing separate, but it's rare. Requirements for the head of household status. So you must be unmarried at the end of the year or considered an abandoned spouse. An abandoned spouse means that you have not lived with your spouse for the last 6 months and you have a dependent child that lives with you. Now, if you're separated and this has happened, I would encourage the person to file immediately to claim the dependent and abandoned spouse, which means although you're still married, you don't have to file married filing separate. You file head of household abandoned spouse. You must pay more than half the cost of maintaining a household for a dependent relative for more than half the household for a dependent relative for more than half the year. A dependent relative may be someone unrelated to the taxpayer for purposes of determining dependency deduction. Head of household status cannot be claimed if the taxpayer's only dependents are those who are unrelated by blood or marriage. Exceptions. You maintain a separate house for your parents if at least one parent qualifies as a dependent. For example, if I'm paying for my parents, but one of them lives in a nursing home because they need more care than I can provide, I could still claim them if I'm providing more than half the support, even though their address is at the nursing home. Special exception. A married taxpayer may use the head of household if they are married, they file as a separate tax return from their spouse, and they maintain a household for more than half the taxable year as a principal abode of a child who is their dependent. They furnish over half the cost of maintaining the house, and the spouse is not a member of the household during the last 6 months. So this is the abandoned spouse rule. Dependency test. Taxpayers can claim a dependent for each person who is considered a qualifying child or qualifying relative. A qualifying child might not be the taxpayer's child at all. A qualifying relative, in some cases, may not be a relative. All dependencies must satisfy the joint return test and the citizenship test. A joint return. So in general, for me to claim someone as a dependent, they must pass the joint return test. A married dependent may not file a joint return with a spouse unless it's filed only to claim a refund, and neither spouse is required to file a return, and no tax liability exists for either spouse on their separate returns. They must also be a citizen or national of the U.S., a resident of U.S., Mexico, or Canada in order to be a dependent. A qualifying child test, one of three. In addition to the joint test and the residency test, a qualifying child must meet each of the four tests. They must meet the relationship test, the abode test, the age test, and the support test. So let's talk about the relationship test. A qualifying child of a taxpayer may be the taxpayer's child, a descendant of the child. Therefore, if I have a child, my grandchild, the taxpayer's brother or sister, so as long as they are younger than me. So my brother, my sister, my stepbrother, my stepsister, my half-brother, half-sister. Or a descendant, so my niece or my nephew, my stepbrother, stepsister, half-sister. Once the relationship is established by marriage, it continues even if we get a divorce. So if you have a stepchild, but then you get a divorce, they are still considered your child, depending on if they live with you, even though you got a divorce from their biological parent. So an abode test, and also this counts if you adopt a child. Abode test, the child must live with the taxpayer more than half the year. Temporary absences, like being away at college, don't count as living someplace else. So if you have a child in college, but when they come home from college, they live with you, and you provide more than half their support, they're your child. Age test, they must be under the age of 19 at the end of the calendar year, or a student under the age of 24. They must be attending a full-time student during 5 months of the year. So if they're in college and they're 23 and you provide more than half their support and they live with you, then that still counts as your child. The support test. The child does not provide more than half of their own support during the year. If a full-time child, scholarships are not considered support. But if I'm paying for college, that can count for support as well. In addition to a joint return test and a residency test, a qualifying relative must meet the following: the relationship test, the gross income test, and support test. If you have the child at college and they're a qualifying child, they meet all the tests that we just talked about, they could earn $15,000. If they're not using it for their support, like let's just say they're putting it away and saving it and you're paying for their support, then that still counts as your child. But if they are not a qualifying child, if they've passed that, don't pass those relationship tests, they could still be a qualifying relative, but now gross income comes into play. So a qualifying relative test, so the relationship test, they must be a child or descendant of the child, a brother, a sister, a stepbrother, or stepsister, a parent or an ancestor, the taxpayer's stepmother or stepfather, a child of the taxpayer's sibling, a sibling of the taxpayer's parents, a son-in-law, a daughter-in-law, a father-in-law, a brother-in-law, a sister-in-law, or any individual who may totally be unrelated for the taxable year that has the same principal abode. So let's just say I have my cousin, which doesn't fall in any of these relationship tests, but they meet all the other criteria and they live with me for the whole year and I'm providing their support and they don't pass the gross income limitation, then they could be my qualifying relative. Or it could be my boyfriend or girlfriend, assuming that they meet all the other tests and I'm providing their support. So gross income test. Dependent's gross income is less than the personal exemption amount. Support test. Taxpayers must provide more than half of the dependent's support. There are opportunities for a multiple support agreement. Usually this happens if we're taking care of a child or a sibling that needs additional support. So a group providing more than half the support may claim a person as though no one taxpayer provides more than half the support. So my brother, my sister, and I provide support for my mother in this example. We each provide 33%. So no one provides more than 50, but together we provide 100%. Each eligible party must meet all the other dependency requirements. Historically, the qualifying person had to sign an agreement not to claim the personal exemption for that year. Since there's no personal exemption, basically, if one of us claims my mother, then because we're all providing half her support and she lives in a nursing home, we can agree to who claims her. Support of children of divorced parents. So post 1984 divorce decrees, custodial parent is entitled to claim the children as a dependent. The non-custodial parent may claim the child as dependent if custodial parent releases the claim of exemption. So there is no exemption after 2017. If the child lives with both parents equal amount of time, the parent with the higher AGI gets to claim the child as a dependent. So this is usually settled in a divorce agreement, but the IRS, will have you work that out as that is a family court matter. So if both of you try to claim the child, it becomes really messy. Okay, so phase out of the personal dependency. So this was repealed after 2017. Before, you used to get a personal dependency and it was phased out, but in 2018 and 2019, you don't. So we're moving on from that slide. For years beginning after 2025, a personal dependency exemption may be claimed at an adjusted inflation-adjusted rate and is subject to phase-out for higher income tax earners. Connie files single with no dependents for 2017. She has AGI of 293, and which exceeds the threshold of 261. Her personal exemption is reduced. So this was for 2017. So a standard deduction of a dependent. A taxpayer who is single, a taxpayer who is a dependent of another will have a limited standard deduction equal to $1,050 or $350 plus earned income. Example of a dependent with a standard deduction. Trevor, 17, and can be claimed as a dependent by his parents. He earns $3,000 in wages and $400 in interest during 2018. His basic standard deduction is $3,350, or his earned income, so not the interest, earned income plus $350. So his taxable income would be $50. So his wages plus interest less the standard deduction equals $50. So he's going to have taxable income of $50. Now Brandon is 17 and can be claimed as a dependent by his parents. In 2018, he earns $13,000 in wages. His basic standard deduction is the $12,000. It's the regular. It can't be more than the maximum standard deduction. So he has $13,000 in wages, no personal exemption, and the regular single standard deduction of $12,000, which means he has taxable income of $1,000. Now an example of another dependent. Martha is 72 and single and can be claimed as a dependent by her daughter. She has $3,000 of interest income. Her basic standard deduction is $1,050. Her total standard deduction is $1,050 plus $1,600 for her age if she's over 65. So she's got $3,000 in interest income, but none of that is earned income because interest isn't considered earned, it's passive. And so she subtracts the basic standard deduction and then the extra for her age, so she only has taxable income of $350. Now let's talk about the kiddie taxes. There was significant change to the kiddie tax in 2018 and the kiddie tax rates, which makes it it's a disadvantage to have passive income to your children. So net unearned income for children under the age of 19 living with a living parent up to the age of 24 as a full-time student that can be claimed as a dependent is taxed at tax rates attributable to trust and estate. Net unearned income does not include your basic standard deduction for unearned income, which is $1,050. And then the next $1,050, which is taxed at the child's marginal rate. So the first $2,100 is taxed at, first is zero, and then the next one is taxed at the child's rate. But anything over $2,100 is going to be taxed at states and the trust and estates tax. So what is unearned income? It's interest, dividends, capital gains, royalties, rents, pension and annuity, and unearned income from a trust. So what they don't want parents doing is putting passive income in the child's name so that they can avoid paying taxes at their personal rates. So they've made it very expensive to put this type of income in your children's name. Avoid investing in saving bonds and invest in gross securities. So what's a tax strategy on this? So if you do have money that you're putting in your children's name, put it in something else that's not going to pay immediate interest and dividends that would be taxable. So put it in gross securities. So that all of that would remain inside the portfolio instead of paying out interest and dividends. Here's an example of unearned income in 2018. Tate is 17 years old. His wages are $4,000 and interest income is $3,000. He had no expenses related to producing the interest income. He's a qualified dependent of his children. His net unearned income is $900, which is the $3,000 of interest that it says, minus the exempt amount of $1,050 and the amount taxed at his rate of $1,050. His taxable income for 2018 is $2,650. His standard deduction is his earned income of $4,000 plus $350. So let's walk you through it. He's got wages of $4,000, interest of $3,000. He's got a total income of $7,000. He's got a standard deduction of $4,350. His taxable income is $2,650. $900 of that is taxed at his rate, the trust rate, because we calculated it right over here, minus the exemption, minus the amount at his rate. So $900 he has to pay trust tax rates on, and then $1,750 he'll pay his individual rate on. Another example. So Marcia is 16 and qualified dependent of her parents. She has unearned income of $5,000. For 2019, $2,900 of her unearned is taxed at trust tax rates. Because she has no earned income, she just gets the standard deduction of $1,050 and the amount taxed at her personal tax rate, which leaves $2,900 taxed at trust tax rates. So the changes. So the Tax Cuts and Jobs Act of 2017 simplifies the kiddie tax by applying ordinary and capital gains rates applicable to trusts and estates to the net unearned income of a child. This implies that earned income is taxed based on a single tax rate. The applicable parental tax will now be calculated by subjecting the children's income to trust tax. I believe that the trust tax will go up much quicker than the parents' tax rate, and they should probably just leave it in their name until the child is considered no longer a dependent. Here are the trust tax rates. So you are at the highest personal income tax bracket after $12,000 of unearned income, whereas the parents wouldn't be at $12,000 of unearned income. The parents could still be at 24%, depending. So who must file a return? You must file a return if your gross income is higher than the standard deduction post personal exemption. By the way, we have no personal exemption now in 2018. So that means a single individual would file a return if they have more than $12,000. And a married filing joint would be more than $24,000. But you have to also consider that depending on the type of income, you might have to file a tax return even if you're below that threshold. You must file by April 15th of the following year. Non-corporate fiscal taxpayers file on or before the 15th of the day of the fourth month closing the fiscal year. Corporate taxpayers must file on or before the 15th of the third date following. Applications for extension can be filed by the due date. An automatic extension is available for 6 months. So personal extensions are due on October 15th, technically, for a calendar year. When to file a tax return. So I'm not going to do 2017 because this isn't relevant. So when to file a tax return. So the basic standard deduction is $2,400. And one of them is over 65, so then they have to file if they have more than $25,300 in income. I'm not doing 2017. So Harold is unmarried and blind and 68, so therefore he's got the $12,000 plus the $1,600 for being blind, for his age. His blindness does not count into this calculation, so if he has more than 13,600, he needs to file. So let's talk about FICA taxes. FICA are the Federal Insurance Contribution Act. It provides for old age survivors, disabilities, hospital insurance. So basically this is Social Security and Medicare. At the current 2017 rate, the Social Security wage limit is $128,400. So if you earn that wage, you have to pay Social Security tax. The employer pays 6.2% and the employee pays 6.2%. Medicare does not have a maximum wage, so therefore it's on all wages. So 1.45% to the employee and 1.45% to the employer. There is an additional 3.8 Medicare tax. This applies to the lesser of net investment income or modified AGI over $250,000 for married filing joint, $125 married filing single, and $200,000. Net investment income includes portfolio income, income from passive activities, so rental properties, dividends, interest, gains on the disposal of properties, but does not include distributions from IRAs or qualified plans. Threshold amounts are not indexed for inflation, by the way. So if you make married filing joint combined more than $250,000, but you have a decent amount of, if you have investment income, reported dividends, capital gains, rental, you would be subject to this 3.8% additional Medicare on top of what you already paid for your wages. High income Medicare tax. Also, there's an additional Medicare tax equal to 0.9% of wages during any taxable year after December 2012, which are in excess of $250 for married filing joint and married filing separate, $125 and $200. This Medicare tax is paid by employees, not the employer, and it applies to wages, compensation, or self-employment income, and these are not adjusted for inflation. Then they have FUTA, which is the Federal Unemployment Tax Act. This is paid by employers only. It's 6% of the first $7,000 in wages. This is to cover unemployment. But Massachusetts has an unemployment. So then we have self-employment tax. So FICA, which is the 15.3 for 2018, is subject. So people who are self-employed, all their net earnings are taxed at 15.3% for FICA. Then they're also taxed for federal income tax and state if you're subject to state. So the 2.9% beyond the wage base of Medicare tax is applicable for self-employment individuals. They must pay this. And then self-employed workers are not required to pay FUTA on themselves, but they are required to pay FICA. Some basic tax planning principles. So number one, if you receive income in tax-exempt excludable forms, so things that we can do. We could invest in municipal bonds if we are in a high income tax bracket. We could also shift income to related taxpayers. This does not work if it's passive income. It does work if, for example, our child is 17 and we can hire them to work for us, and they do work. So that's income shifting. We could generate income that is taxed at a favorable capital gains rate. So we could put our money into something that is taxed at a lower, taxed at dividend rates that are lower or capital gains rates that are lower. We could also put money into a retirement account that is tax deferred. We could also buy growth stocks that won't pay dividends right now, and we could hold those so we wouldn't have tax implications to that income earning. And then we would use tax credits to reduce liabilities. A final thought. It is against the law to evade paying income taxes, but a long-standing landmark U.S. Supreme Court decision states that it is okay to legally avoid paying income taxes. So I aim to help clients avoid paying taxes without evading them. It is the hallmark of all financial advice. And that's it.